Hello and welcome to Swak Academy. In this video I will make an in-depth stock fundamental analysis of the company Xiaomi. I will cover its history, business model, growth, balance sheet, profitability and valuation. Xiaomi was founded in 2010. Its headquarters is in Beijing, China. Its founder and current CEO is Lei Jun. The company has $40 billion in market cap. Its stock is trading at $1.59 at the time I'm making this video. Xiaomi Corporation is a Chinese designer and manufacturer of consumer electronics and related software, home appliances and household hardware. Behind Samsung, it is the second largest manufacturer of smartphones in the world. Initially, the company only sold its products online. However, it later opened brick and mortar stores. By 2015, it was developing a wide range of consumer electronics. It is also a major manufacturer of appliances including televisions, flashlights, unmanned aerial vehicles, and air purifiers using its Internet of Things and Xiaomi smart home product ecosystems. On 30 of March 2021, Xiaomi announced that it will invest $10 billion in electric vehicles over the following 10 years. Xiaomi electric car is expected to start mass production in 2024. Xiaomi competes with other companies that sell consumer electronic hardware. Major competitors include Apple, Alphabet, Huawei, Samsung, and others. Now let's discuss the company's growth. Xiaomi grew its revenue from $10.3 billion in 2015 to $40.1 billion in 2022. The revenues peaked in 2021 and reached $51 billion, then decreased to its current value. This revenue decrease does not affect just Xiaomi. It is caused due to the recession we are currently facing, so high inflation and interest rates. The same decrease can be found with the competitor Samsung. Its revenue also decreased from its all-time high in 2021. The majority of Xiaomi revenue is from smartphones. It is good to see that they are also expanding in their other IoT and lifestyle products, as you can see in this chart. Within a couple of years, Xiaomi was able to achieve the rank of the third biggest suppliers of smartphones worldwide. As you can see in this graph, the orange color is number 3 behind Samsung and Apple. Now let's throw a quick look at the profitability of the company. This graph shows the gross profit margin. The gross profit is a result of revenues minus the direct cost of revenue. The gross profit margin is a percentage of gross profit divided by the revenue. As you can see in the gray chart, the gross profit margin of the company is increasing over years and reached 17% in 2021 and 2022. It is low compared to companies like Facebook, but to be expected for a hardware producing company. Now let's check the operating profit and the operating profit margin. Operating profit is the net income derived from a company's core operations. Put another way, it is the amount of money that the company has left over after meeting its operating cost but before paying its taxes. The operating profit peaked in year 2021, reaching $3.1 billion, then decreased in 2022 to $878 million. It is clear that the operating profit of the company is increasing with the revenue, which is good to see and have. Since as a value investor I'm interested in the company for the long term, I do yearly and not quarterly analysis. However, let's check the results for the second quarter of 2023. Xiaomi net profit grew 147%, reaching 5.1 billion RMB or $0.68 billion. So the company is back to grow again. Now let's have a quick look at Xiaomi balance sheet. Xiaomi has 173.4 billion RMB or $23 billion in current assets. The current assets are the assets that are available to the company within 1 year. They include cash and short-term investments. The total current liabilities, which are liabilities which the company must pay within 1 year. Xiaomi total current liabilities are 94.6 billion RMB or $12.5 billion. Xiaomi total liabilities including long-term debt are 136 RMB or $18 billion. By calculating the current assets minus the current liabilities, Xiaomi is left with $10 billion cash on its balance sheet, making the balance sheet extremely strong and healthy. Now let's jump to valuations. Xiaomi has a P/E ratio of 30.8, a price to free cash flow ratio of 12.67, a price to book ratio of 1.84. Pause the video and check how the current ratios compare to previous years. Now let's do a discounted cash flow analysis to determine the fair value of the stock. This is how my model works. I calculate the worst case scenario to determine the downside, a normal case and best case scenario. The first column represents the growth rate for the next 5 years. The second column represents the growth rate for the 5 years afterward. The third column represents the terminal multiple, or the PE multiple at which the stock is sold after 10 years. The fourth column represents the discount rate, or the rate of return the stock will grow over the years. Considering an 8% growth for the next 5 years, a 5% for the years afterward, a terminal multiple of 9 and a discount rate of 15%. The intrinsic value of the stock is $1.34. Check the other growth rates and assumptions. If you believe Xiaomi will grow faster than my conservative assumptions, then the intrinsic value will grow accordingly. I know a discount rate of 15 is high, but if I wanted a 10% return, I will buy an ETF, which is much safer than a stock. 15% is the minimum return I expect from a singular stock. I recommend buying Xiaomi at or below its intrinsic value. Now let's discuss outlook and risks. Xiaomi made it within a couple of years into the third biggest smartphone supplier worldwide. It is able to develop premium products at low prices and selling them at low prices. Xiaomi is expanding into robotics and electric vehicle. This will increase its revenue and earning in the upcoming years. However, Xiaomi is facing competition from various companies. In the past, companies like Nokia and BlackBerry were leading smartphone manufacturer and suppliers. Now no one hears from them. Xiaomi must invest heavily in research and development and stay innovative in order to survive the smartphone business. Finally, the 3M analysis: 1M for moat, 1M for management, and 1M for margin of safety. Xiaomi has a strong moat as a low-cost manufacturer and supplier. It is able to deliver very good and affordable smartphones at attractive prices. The management did a great job thus far growing the company and its revenues. The management is continuously expanding the product portfolio and will enter new sectors with the electric vehicle production. For the margin of safety, Xiaomi is trading slightly above intrinsic value and fair price. The company has an amazing balance sheet. In conclusion, Xiaomi is a great company with great products. I recommend putting it on your watch list until the stock price is below intrinsic value before buying.